And welcome to the latest in a series of transfer pricing webinars conducted by Mayer Brown's Tax Controversy and Transfer Pricing Practices. The focus of today's webinar is financial transactions, particularly the OECD's recent guidance on financial transactions. We'll also consider the ramifications of the ongoing economic downturn for related party financial transactions. I'm Scott Stewart, a partner in Mayer Brown's Tax Controversy and Transfer Pricing Practice in Chicago. My co-presenters are first Astrid Perrone, who is a tax partner in Mayer Brown's Brussels office, and second, Elena Kripanova, who is a PhD economist and is Mayer Brown's Director of Transfer Pricing and Valuation Services, resident in Mayer Brown's Washington, D.C. and Los Angeles offices. Before we get started, I'd like to go over a few housekeeping matters. Please note, when accessing Mayer Brown webinars via our On24 platform, we suggest avoiding use of desktop virtualization software such as Citrix to decrease disruption or quality loss. Secondly, as listed under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there is no dial-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. If you have any questions that are unanswered during the presentation, I invite you to submit them using the Q&A feature on the right side of your screen, and we will do our best to follow up with you directly after the webinar has ended. Regarding CLE credit, we will be providing an alphanumeric code during the presentation. In order to receive CLE credit, participants must record this code on the virtual sign-in sheet that was emailed to you with the login instructions for today's program. These forms are also available to download on the right-hand side of your screen under Resource List if you need them. In addition, please visit our COVID-19 web portal on mayerbrown.com, which is a one-stop resource center that aggregates the latest Mayer Brown legal updates and insights on COVID-19 and includes links to other useful resources. With that said, let's get started. Our presentation today is divided into several parts. First, we will consider intercompany debt transactions, including delineations of transactions and pricing of intergroup debt. Second, we will consider potential consequences of the current economic downturn for intergroup financial transactions. Third, we will discuss cash pooling transactions. And finally, we will discuss intergroup guarantees.
The final transfer pricing guidance on financial transactions was released by the OECD in February of this year. We start our review of the guidance with accurate delineation of a transaction. The final guidance retained the emphasis from the draft that financial transactions between related parties, including the prices charged and the ultimate profit reported as a result of the transaction, can differ from transactions between unrelated parties because the capital structure of a borrowing entity that is part of a multinational group can differ from the capital structure which would exist if it were an independent entity operating under the same or similar circumstance. The final guidance also continues to rely on commentary to Article 9 of the OECD Model Tax Convention, which says that Article 9 is relevant not only in determining whether the interest rate is arm's length, but also whether a prima facie loan can be regarded as a loan or some other kind of payment. This statement highlights the fact that in the current post-BEPS environment, taxpayers should be concerned not only with the pricing of a related party financial transaction, but also whether the transaction will be respected by the relevant tax administration. The final guidance reiterates that accurate delineation of the actual transaction under Chapter 1 will precede any pricing attempt, and therefore whether the transaction is ultimately regarded as debt or equity will be determined separately from the issue of pricing the transaction. The final guidance further reiterates that countries are free to address the debt equity issues and interest deductibility under domestic legislation, which opens the possibility that a transfer of funds may be subject to different sets of rules depending on jurisdiction. The final guidance states that one of its main purposes is to clarify the accurate delineation analysis under Chapter 1 of the Transfer Pricing Guidelines in the context of financial transactions. Section B of the final guidance identifies 3 steps of accurate delineation. Section B1 addresses determination of whether a purported loan should be regarded as a loan. Section B2 identifies the commercial or financial relations, and Section B3 discusses the economically relevant characteristics of actual financial transactions. We will now take a look at each of these steps. The final guidance retained the discussion from the draft that to accurately delineate an advance of funds, several factors should be considered, including the presence or absence of a fixed repayment date, the obligation to pay interest, the right to enforce payment of principal and interest, and the ability of the recipient of the funds to obtain loans from unrelated lending institutions. Many of these factors resonate with domestic rules in various jurisdictions, including those in the United States, when determining whether an advance of funds should be characterized as debt or equity for tax purposes. We reviewed these issues in detail in our previous webinar on financial transactions. The final guidance has retained the language from the draft that distinguishes the accurate delineation of the transaction from a traditional debt equity analysis by stating that the accurately delineated amount for transfer pricing purposes would be a function of the maximum amount that an unrelated lender would lend and the maximum amount that an unrelated borrower would borrow. What is different here from the typical approaches to analyzing financial transactions is that both parties to the transaction, the borrower and the lender, are considered. As you recall from the previous slide, most of the characteristics of the transaction had to do with the borrower, not with the lender. The final guidance further emphasizes that options realistically available should be considered from the perspective of each of the parties to the transaction. Realistically available options from the lender's standpoint are other investment opportunities. From the borrower's perspective, the options realistically available will include broader considerations than the entity's ability to service its debt, such as whether to avoid placing negative pressure on its debt rating and increasing its cost of capital and jeopardizing its access to capital markets and its market reputation. It is not immediately apparent how the options realistically available will be factored into the accurate delineation of the transaction. As we noted earlier, the second prong of the accurate delineation of the transaction is identification of the commercial or financial relations. In this step of accurate delineation, we analyze the factors that affect the performance of businesses in the industry in which the multinational group operates, including the particular point of industry in its life cycle, the effect of government regulations, or the availability of financial resources in a given industry. As part of accurate delineation, we need to develop an understanding of how the particular multinational group responds to these identified factors. For example, whether the multinational group is targeting a specific credit rating or debt equity ratio, or whether the group is adopting a different funding strategy than the one observed in its industry sector. Multinational groups' behavior may also include groups' policies with regard to the funding needs among different projects and considerations of the strategic significance of a particular entity within the multinational group. These factors at the level of industry and the multinational group will define the market and industry environment within which the multinational group operates and will affect both the quantum and pricing of a transaction. For example, differences between industries can manifest themselves through different amount and type of financing required due to different capital intensity levels between industries. Once we understand the macro environment at the level of industry and the multinational group, we take a more granular look at the economically relevant characteristics of the transaction, including its contractual terms, the functions performed, assets used, and risks assumed by the parties, and the characteristics of the financial product or service under review. The true nature of many of these characteristics is revealed during the time of financial distress. Specifically, is the written agreement still consistent with actual conduct of the parties? For example, does the borrower continue to make the principal and interest payments per the terms of the loan? Which party evaluates the risks inherent in the loan, decides whether and under which terms to advance the loans, and has the capability to commit capital of the business to the investment? For example, during the good times, the decision might have been made by a financing arm of the multinational group, but when the terms are difficult, the decision-making authority might have switched to the parent, which would inevitably raise a question of which party truly managed and controlled the associated risks. Another question to consider is whether the product is what it purports to be, that is, whether it is debt or equity, if lender forgives the loan during difficult economic conditions. Finally, the question should be raised whether the financial product is consistent with the multinational group's global financing policy and the existing relationships between the associated enterprises. For example, whether a 10-year loan is a true term loan or a series of a refreshed one-year revolver loans, as in example in paragraph 1037 of the final guidance.
As just said, to identify the economically relevant characteristic of actual financial transaction, the contractual terms should be considered. The terms and conditions of a financial transaction are usually explicitly covered in a written agreement. Those agreements should reflect the actual conduct of the parties, even in case of financial distress, and be detailed enough to provide information on how the responsibilities, risk, and anticipated outcomes were intended to be divided when the agreement has been concluded. If the agreements do not provide enough details or are inconsistent with the actual conduct of the parties, the new guidance recommends to look to other documents, to the actual conduct of the parties, and the economic principles that generally govern relationships between independent enterprises in comparable circumstances. We will now review specific issues related to the pricing of financial transactions, starting with intragroup loans. The accurately delineated transaction should then be priced in accordance with tools and methods set out in the OECD transfer pricing guideline and taking into account the financial and other consequences of risk assumption and the remuneration for risk management. The guidance in Chapter 1 of the 2017 guidelines applies to risk related to intragroup loans. Entities that provide funding without exercising any control over the financial risk of providing funding are treated as not assuming any risk at all. Accordingly, such related parties are limited to a risk-free return. In Chapter 6, the 2017 guidelines propose to limit returns for providing funds without more to a risk-adjusted return on the funding. The new guidance provides general consideration before discussing the pricing method. Those considerations are listed on this slide, starting with lenders and borrowers' perspective. As said before, the OECD transfer pricing guidelines of 2017 mostly focused on the lender's perspective. According to the new guidance, both the lenders and borrowers' perspective need to be considered. Practical guidance is provided, such as on the lender side, the necessity to perform a credit assessment. When an enterprise is making a loan to an associate enterprise, it will not necessarily follow all of the same processes as an independent lender. However, it will consider the same commercial considerations, such as credit worthiness, credit risk, and economic circumstances. Regarding shareholders' loan, the guidance states that the parent already has control and ownership of the subsidiary and derives from this statement a debatable conclusion that those loans could be priced as if they were secure, and this even if they are not secure according to the loan agreement. On the borrower side, the realistically available alternatives need to be considered. When considering those options, the guidance states that an independent borrower will seek the most cost-effective solution. Regarding the use of group credit rating, even if separate entity credit rating seems to be favored in the new guidance, it accepts the use of group rating if the separate entity credit rating is not reliable. Regarding covenants, the guidance suggests that in absence of the usual financial covenants, they may be assumed to exist with the related impact on the pricing. The other points will be discussed in the following slides. The creditworthiness of the borrower is one of the main factors that independent investors take into consideration when determining an interest rate. Credit ratings provide an opinion about the overall creditworthiness of an M&E or an M&E group, or an opinion for a specific debt issuance. It depends on a combination of quantitative and qualitative factors, and the same financial metrics can produce different credit ratings depending on the industry. Special circumstances such as startup entities or those that have recently been part of a merger should be taken into consideration. The new guidance considers the publicly available credit ratings as informative only, and publicly available financial tools to calculate credit ratings as not sufficiently reliable on a standalone basis. What the new guidance says about the use of the credit ratings is, once the actual transaction has been accurately delineated, arm's length interest rate can be sought based on consideration of the credit rating of the borrower or the rating of the specific issuance, taking into account all of the terms and conditions of the loan and comparability factors. The effect of group membership is relevant for identifying the condition under which an M&A would have borrowed from an independent lender at arm's length in two ways. The external funding policies and practices of group management will assist in informing the form and term and condition of the debt the M&A would have entered into with an independent lender, including the pricing and all economically relevant characteristics such as the type of loan, its term, currency, security, covenants, business strategy, and so forth. This information is provided in the master file when transfer pricing documentation is required. The M&E may also receive support from the group. In the context of intragroup loans, this incidental benefit that the M&E is assumed to receive solely because of group affiliation is referred to as implicit support. It may affect the credit rating of the borrower or the rating of the debt issuer. It may depend on the relative importance of the entity to the M&E group as a whole and the leakage between the entity and the rest of the M&E group, or the likely consequence for other parts of the M&E group of supporting or not supporting the borrower. As stated in the guidance, the impact of an assessment of implicit support is a matter of judgment.
The final guidance provides several potential methods for pricing of intercompany debt. The most straightforward is the cup method, which, according to the final guidance, is easier to apply to financial transactions than to other types of transactions because of the active markets for borrowing and lending money and the frequency of such transactions between independent borrowers and lenders. The final guidance emphasizes that the possibility of internal cups should not be overlooked. The guidance states that it is unlikely that the multinational group's average interest rate paid on its external debt meets the comparability requirements to be considered as an internal cup, but it may be possible to identify potential comparable loans within the borrower's or its multinational group's financing with an independent lender as the counterparty. If comparable loans cannot be found, arm's length interest rates can be also based on the return of realistic alternative transactions with comparable economic characteristics, such as bond issuances. In line with the accurate delineation of the transaction, the application of the CUP method requires one to consider the perspectives of lender and borrower. Lenders would typically consider whether to make a loan, how much to lend, and on what terms. Borrowers would typically prefer to have the right funding available to meet both short-term needs and long-term objectives. Another proposed method is the cost of funds, which considers the borrowing costs incurred by the lender in raising the funds to lend, plus the expenses of arranging the loan and the relevant costs incurred in servicing the loan, a risk premium to reflect the various economic factors inherent in the proposed loan, plus a profit margin. Because of competitive environment, the lender cannot simply charge based on its cost of funds, but instead should consider the cost of funds relative to other lenders operating in the market. In some intragroup transactions, one of the situations where the cost of funds approach may be used is where only agency or intermediary functions are being performed. For example, where capital is borrowed from an unrelated party, passes from the original borrower through one or more associated intermediary enterprises as a series of loans until it reaches the ultimate borrower. As before, both parties to the transaction should be considered. Yet another proposed method is based on credit default swaps. The final guidance suggests that the spreads of credit default swaps may be used to calculate the risk premium associated to intragroup loans. The final guidance does not provide details of how to apply the CDS, but it warns that the CDSs may be subject to a high degree of volatility and may reflect not only the risk of default, but also other non-related factors. Another proposed method is economic modeling. In this method, an interest rate would be calculated through a combination of a risk-free rate and the number of premiums associated with different aspects of the loan. For example, a premium for default risk, a premium for liquidity risk, and a premium for expected inflation or for loan maturity. Obviously, the reliability of this method depends upon the parameters factored into the specific model and the underlying assumptions. Finally, the guidance mentions the bank opinions as a potential method. A bankability opinion states what interest rate the bank would apply if it were to make a comparable loan to that particular enterprise. The OECD considers bank opinions a departure from an arm's length approach based on comparability because they do not constitute an actual offer to lend. According to the OECD, such letters would not therefore generally be regarded as providing evidence of arm's length terms and conditions. Nonetheless, bank opinions are frequently used in practice and thus cannot be summarily dismissed.
With COVID-19, access to cash becomes more challenging. Enterprises are looking to draw cash from all existing internal and external facilities and resources. Transfer pricing becomes critical and should be refined in light of those new circumstances. COVID-19 creates a stress on financial system. There are failures by borrowers to meet payment obligations in accordance with the term of the loan. There are changes in interest rates. There is a volatility in exchange rates. In such cases, a transfer pricing analysis should be done regarding the possibility of the borrower or the lender to renegotiate the terms of the loan to benefit from better conditions. Such analysis will take into consideration the option realistically available to both the borrower and the lender. The basic question would be, what would unrelated parties do in similar circumstances? Is the creditworthiness of the borrower change, and how will this affect the terms of the loan? Is the value of the collateral change? Would an unrelated lender seek a formal guarantee from the parent to support local business? Comparability will also be under pressure. Regarding credit rating, they will be affected for many groups in many industries. The uncertainty reduces reliability of financial projection and also touch qualitative factors such as the management ability to cope with the downturn, industry-specific features, and the entity's market share in its industry. The interest rate benchmarking may also need to be refreshed. Regarding implicit report, you will remember that the new guidance, recognizes the difficulty of assessing implicit report. This is a matter of judgment. Also, government incentives can play a key role in funding in the coming months. As a result, affiliate companies may obtain financing on terms more favorable than market. Do such terms need to be reflected in intercompany financing arrangements? Regarding other challenges, we may also note the following. Distressed entities may require financial support, leading to potential debt versus equity consideration in the context of the accurate delineation of the transaction. Regarding intercompany agreements, they should reflect the actual conduct of the parties and an assessment if any key terms and conditions are missing from existing or new instruments. There is a need to map key terms from external financing arrangements to those of internal ones. Of course, there may be valid business reasons to depart from original agreements if it gives both parties better prospects, extension of maturities, temporary grace periods, adjustment of covenant computation to correct for temporary drop of ratios. Also, current intragroup financing structure could become tainted if external borrowings are placed under default or FinCap thresholds breach. In any event, the key question remains, what would unrelated parties do under similar business circumstances?
Before looking at 1001-3, it's useful to consider for a moment the Supreme Court's decision in Cottage Savings Association, which led in large part to the 1001-3 regulations. Cottage Savings Association held interest in a large number of mortgages. In order to recognize a loss for tax purposes, Cottage Savings sold its interest in some of its mortgages and purchased other mortgages to replace them. The IRS disallowed the loss on the theory that the old mortgages were substantially similar to the new mortgages and therefore no change in assets had occurred. The Supreme Court held for the taxpayer, deciding that the new mortgages were different assets and therefore a loss was recognized. While a favorable result for the taxpayer, the decision left open the question of when a change in assets was substantial enough to have tax consequences. In response to Cottage Savings, Treasury promulgated Regulation 1001-3. The regulation provides a number of bright line tests to determine when a change to a debt instrument has tax consequences. Generally speaking, in order for tax consequences to arise, there must be a modification of a debt instrument, and the modification must be economically significant. Before looking in detail at Regulation 1001-3, let's consider some of the potential tax consequences of a significant modification. First, the holder of the debt instrument may recognize gain or loss. Second, the issuer of the debt may recognize cancellation of indebtedness income. Third, depending on the face amount of the new debt, it may be treated as issued with original issue discount, which must be accounted for over time. It's important to note, though, that changes in the value of a debt instrument due solely to a decline in the credit quality of the obligor are generally ignored for purposes of 1001-3. It's also important to note that 1001-3 provides taxpayers some leeway to modify debt instruments in response to adverse economic conditions without suffering adverse tax consequences. Under 1001-3, certain significant modifications of a debt instrument will result in a deemed exchange of the unmodified instrument or the old debt for the modified debt instrument or the new debt. The old debt is treated as redeemed for an amount equal to the issue price of the new debt. The new debt will be treated as a newly issued debt instrument with a new issue price. Regulation 1001-1 provides that a deemed exchange will occur if a debt instrument is modified so that it differs materially either in kind or in extent from the original debt instrument. Determining whether an altered debt instrument differs materially in kind or in extent from the original instrument requires a two-step analysis. First, is there a modification? Second, is the modification significant? A modification generally means any change or alteration to a right or obligation of the issuer. The change or alteration can be evidenced in writing, by oral agreement, or by the conduct of the parties. The form of the modification is generally irrelevant and may occur through an actual debt exchange or an amendment to a loan agreement. Generally, a modification is treated as occurring at the time the issuer and holder enter into an agreement to modify the instrument, even if the modification is not immediately effective. Generally, a change that arises due to the operation of the terms of the original instrument is not considered a modification. An example might be a floating rate instrument. Further, while modification is broadly construed, the failure of an issuer to perform its obligations is not itself a modification unless other conditions are met. Let's talk for a minute about forbearance. One form of modification arises from the holder's agreement to stay collection or temporarily waive an acceleration clause, but only if the period of forbearance exceeds 2 years following the issuer's failure to perform, plus any period of good faith negotiations. This 2-year grace period is fairly generous to taxpayers. If the parties agree to new terms, however, there will be a modification. Further, any change to the payment schedule is a modification that may be significant. For example, moving foreborn payments to the end of the payment schedule is a modification that would require testing for significance. Third, change in obligor or security. Fourth, change in the nature of the debt instrument. And fifth, changes in accounting or financial covenants. Let's look first at change in yield. With regard to a change in yield, the change is significant if the modified yield varies from the yield on the old instrument by the greater of either 0.25% or 5% of the annual yield of the unmodified instrument. Modified yield is the annual yield of the debt instrument with an issue price equal to the adjusted issue price of the unmodified instrument and payments equal to the payments on the modified debt instrument from the date of modification. A modification is also significant if it results in the material deferral of scheduled payments. The materiality of the deferral depends upon all the facts and circumstances, including the length of the deferral, the original term of the instrument, the amount of the payments that are deferred, and the time period between the modification and the actual deferral of payments. There are certain safe harbors involved here. Deferral of scheduled payments is not a material deferral if the deferred payments are unconditionally payable no later than at the end of the period that begins on the original due date of the first scheduled payment that is deferred and extends for a period equal to the lesser of, first, 5 years, or second, 50% of the original term of the instrument. Historically, tax practitioners have been unwilling to opine outside of the safe harbor. Guarantee on the instrument is a significant modification only if it results in a change in payment expectations. Now let's consider non-recourse debt. A modification that releases, substitutes, or otherwise alters a substantial amount of the collateral for, or guarantee or other credit enhancement for the debt instrument is a significant modification. This rule does not mention changes in payment expectations. Exceptions from the non-recourse rule, in other words, these are not significant modifications, exist for, first, a substitution of collateral if the collateral is fungible, or second, the substitution of similar commercially available credit enhancement contracts. Now let's talk about changes in covenants. A modification that adds, deletes, or alters customary accounting or financial covenants is not a significant modification. Financial covenants not constituting a significant modification include debt-to-cash flow ratios, requirements on board meetings, and employee compensation limits. This rule may be particularly important during times of financial distress, since debtors may breach covenants included in the original debt instrument due to the economic downturn.
In the COVID-19 environment, we would strongly urge the multinationals to monitor on a contemporaneous basis any internal developments with regard to intercompany debt. This includes preparing documentation to support financing decisions taken in respect of COVID-19, whether these decisions concern the existing debt that needs to be modified or whether this is a new loan. Taxpayers would also be advised to consider how to document unexpected costs from renegotiating financing arrangements with third parties and whether those costs are relevant for intercompany financing, as well as consider whether financial ratios have changed and whether this change affected the entity's credit rating. The objective in the current environment is to assess any economic and financial changes in a comprehensive manner, using as a barometer third-party behavior in comparable circumstances. In the frequently asked questions published by the IRS on April 14 of this year, the service advises taxpayers to document and explain how the unforeseen business circumstances caused the observed financial results and how the results were not caused by intercompany prices. The IRS warns against manipulating the taxpayers' set of comparable companies in order to fit the taxpayers' results into the new interquartile range.
Now let's talk about deductibility of interest. As economic conditions change, another topic worth considering is limits on deductibility of interest. Section 163J limits a taxpayer's ability to deduct interest to a percentage of the taxpayer's, quote, adjusted taxable income, close quote, which approximates interest income plus EBITDA. For many years prior to the Tax Cuts and Jobs Act, or TCJA, Section 163 generally limited the taxpayer's interest deductions to 50% of the taxpayer's adjusted taxable income. In practice, this was a fairly generous limitation, which was rarely breached. The TCJA sharply curtailed the limitation on interest deductions to 30% of adjusted taxable income. For taxpayers with sharply reduced income, the TCJA's limitation could result in the taxpayer owing cash taxes, even though it incurred an economic loss. For tax years beginning in 2019 and 2020, the CARES Act temporarily restores the prior limit of 50% of adjusted taxable income. Taxpayers may also elect to use their 2019 adjusted taxable income to determine their 163J limitation for 2020. The CARES Act left unchanged a rule from the TCJA that would reduce adjusted taxable income from, in essence, EBITDA to EBIT for tax years beginning after December 31st, 2021.
EU did implement OECD best practices recommendation through the Directive on Rules Against Tax Avoidance, also called ATAT1. ATAT1 was implemented in national laws by December 31, 2018 and covers limitation of interest deduction. The directive, in line with BEPS Action 4, stipulates that interest expenses that exceed interest revenue should be deductible in the tax period in which it arises to the extent of 30% of the company's EBITDA. COVID-19 may create challenges to deduct interest for tax purposes. When borrowers are facing reduction of EBITDA and potentially increased borrowing costs, limitation of interest may create an issue. When COVID-19 results in substantial modification to the contract, such substantial modification to the contract may lead to adverse tax consequences. The end of the grandfathering rules benefiting the loans existing before the directive, and also, even not transfer pricing question, withholding tax on accrued interest can also be due in some countries. We will now review the specific transfer pricing consideration connected to cash pooling. In the context of the new guidance, cash pooling is the pooling of cash balances as part of a short-term liquidity management arrangement. The accurate delineation of cash pooling arrangements will need to take into account not only the facts and circumstances of the balance transfer, but the wider context of the condition of the pooling arrangement as a whole. Pooling arrangements not only reduce external funding costs, but they can also generate bargaining power possibilities, resulting in better terms with the banks, in particular a reduction of banking fees. The cash pool leader can be a mere coordinator in certain national pooling arrangements, but the remuneration should always depend on the functional analysis and specifically the allocation of risk. This risk could include liquidity risk and credit risk. Liquidity risk arises from the mismatch between the maturity of the credit and debit balances of the cash pool members. Credit risk refers to the risk of loss resulting from the inability of cash pool members with debit position to repay their cash withdrawals. Regarding pricing, the new guidance states that a cash pool leader carries out minimal functions on a national cash pooling arrangement compared to a physical cash pooling and should not receive its remuneration from an adjustment to the interest rate. There is, in fact, a general assumption that the cash pooling leader performs no more than a coordination function with a limited remuneration. If it's doing other activities other than coordination or agency functions, those activities should be priced according to the approaches described in the other part of the guidance. Regarding the cash pool members, the synergy benefits should be allocated amongst the members, and the mechanism for distribution of benefits between pool members should take into account the rationale used by the bank on the master account. It is expected that all cash pool participants will be better off than in absence of the cash pool arrangement. What is the impact of COVID-19? As external sources of capital dissipate and cash flow from operations reduce, cash pooling amongst related parties can become the source of liquidity. And the terms of intragroup agreements may come under pressure if liquidity constraints could cause limits to be reached on existing lines of credit. There is an important question in case of insolvency by participants or other account holders. The pooling agreement with the bank is indeed likely to require full cross guarantees between all pool participants. In case of a default from another group member, the support could be regarded according to the guidance as a capital contribution. Intercompany guarantees will be discussed in the next slides.
Now let's talk for a few minutes about intercompany guarantees. A guarantee is a legally binding commitment on the part of the guarantor to assume a specified obligation of the guaranteed debtor if the debtor defaults on that obligation. Typically, the guarantee allows the borrower to borrow on terms that would be applicable if it had the credit rating of the guarantor rather than the terms it could obtain based on its own non-guaranteed credit rating. In practice, This means that the entity receiving the guarantee can either borrow more money, borrow at a lower rate, or both, relative to its ability to borrow without the guarantee. A number of types of arrangements that fall short of a formal guarantee have some characteristics of a guarantee. These may range from a written acknowledgement by a parent that it is aware of a loan to its subsidiary, to a mere expectation that a parent is unlikely to let its subsidiary fail. Treasury has not issued specific guidance on when compensation is required for an intercompany guarantee, with the exception of a statement in Regulation 482-9L that seems to establish that passive association standing alone does not result in a compensable benefit. The OECD seems to acknowledge this point as well, stating that, quote, anything less than a legally binding commitment, such as a letter of comfort or other lesser form of credit support, involves no explicit assumption of risk, close quote. The OECD appears to leave the door open, though, to an argument that something less than a formal written guarantee may be compensable. The OECD states that incidental benefits attributable solely to being part of a larger group are not compensable. However, the OECD goes on to state that benefits arising because of deliberate, concerted group actions may give a group a material, clearly identifiable advantage in the marketplace. Consideration must also be given to the likelihood of support, such as the relative importance of the guaranteed entity to the group and the likely consequences for other parts of the group of supporting or not supporting the borrower. In extreme cases, it may be necessary to determine whether a portion of the loan from the lender to the borrower is accurately delineated as a loan from the lender to the guarantor, followed by an equity contribution from the guarantor to the borrower. This was the situation in the well-known plantation patterns case. Consideration also needs to be given to the financial capacity of the guarantor to fulfill its obligations in case of default by the borrower. It may be useful to analyze the credit rating of both the guarantor and the borrower, as well as the correlation between the guarantors and borrowers' businesses. However, the OECD states that a guarantee may provide a benefit to a borrower that has the same or higher credit rating as the guarantor if the guarantee effectively allows the lender to access wider recourse and therefore reduces the interest rate despite the guarantor not having a higher credit rating.
The task of assessing counterparty risk, which can be challenging in normal times, is exacerbated during financial crisis. The cost of obtaining adequate information on the true credit quality of the borrowers can be high, in part because of information vacuum on the current and expected future business performance. The uncertainty brings complications in valuation of assets that could serve as collateral for the loan, as well as complications with determining credit ratings because of questionable reliability of financial projections, key balance sheet items, and cash flow ratios, and uncertain qualitative outlook, including the future of the entity, the industry in which it operates, and the entity's position within its industry. All these issues present challenges to assessing counterparty risk between both related and unrelated parties. But for the entities within the same group, when one needs to establish the arm's length pricing of the financial guarantee, these issues amplify the challenge of estimating the value of the derived benefit and parsing out the value of explicit support from the effect of group affiliation. The solution to these challenges is to adhere to the best principles of accurate delineation of the transaction and never lose sight of the arm's length standard, which informs us about unrelated parties' behavior even in these trying times. The final guidance provides that the principles and methodologies of pricing a guarantee are similar to those explained for loan pricing. The final guidance warns that when the accurate delineation of the actual transaction indicates that the purported guarantee is not a guarantee, other pricing approaches should be considered. In such circumstances, the guidance in Chapter 7, Special Considerations for Intragroup Services, of the 2017 Transfer Pricing Guidelines should be considered. The first method in the final guidance for pricing a guarantee is the comparable uncontrolled price method. The guidance envisions two types of guarantees that can be used as cups. The one where independent guarantors provide guarantees in respect of comparable loans to other borrowers, or where the same borrower, that is, the entity that is being guaranteed by a related party, has other comparable loans which are independently guaranteed. The cup method for guarantees would follow the same principles as the cup method for intercompany debt, but the final guidance envisions difficulty with using the cup method for guarantees, given that unrelated party guarantees of bank loans are uncommon. Another method for pricing a guarantee is a yield approach. This method is pretty straightforward. The upper limit of a price of a guarantee is the spread between the interest rate that would have been payable by the borrower without the guarantee and the interest rate payable with the guarantee. The yield approach is rather inflexible because it adopts an interest rate differential as the sole measure of value and ignores other potential benefits of a guarantee, such as the ability to borrow in larger volumes, the ability to avoid restrictive loan covenants, and the posting of collateral. The guidance warns not to ignore the effect of implicit support. That is, the price of a guarantee should be the difference between the cost to the borrower after taking into account the benefit of any implicit support and the cost with the benefit of the explicit guarantee. The other three approaches, the cost approach, the valuation of expected loss approach, and the capital support method, are presented in the final guidance in a very cursory form without any detailed explanation as to their preferred use. The approaches exhibit some similarities. For example, the guarantee can be priced by reference to capital, either the capital required to support the risks assumed by the guarantor, or capital that would be required to bring the borrower up to the credit rating of the guarantor. The guarantee can also be priced by reference to expected loss. By valuing a guarantee on the basis of calculating the probability of default and making adjustments to account for expected recovery rate in the event of default. The typical approach here is to use option pricing models, based on, in particular, the Black-Scholes formula, whose goal is to quantify the likelihood of default and the amount of loss given default. For example, a guarantee may be analogized to a put option from the perspective of the lender. In this case, the guarantor sells to the lender the right to put the loan to the guarantor in the event of default. If a guarantee is analogized to a put option from the perspective of the borrower, the guarantor sells to the borrower the right to put its assets to the guarantor for the outstanding amount of the guaranteed debt. The applicability and reliability of these methods, as is often the case in transfer pricing, depend on facts and circumstances of the underlying transactions.
Our webinar today considered several topics. First, we considered intercompany debt transactions, including delineation of debt transactions and pricing of intergroup debt. Second, we considered potential consequences of the current economic downturn for intergroup financial transactions. Third, we discussed cash pooling transactions. And finally, we discussed intragroup guarantees. As we discussed, the 1001-3 regulations address the significance of certain types of debt modifications that may be important to taxpayers in light of the current economic downturn. These changes include changes in yield on a debt instrument, changes in timing of payments, changes in obligor or security, and changes in accounting or financial covenants. The regulations under Section 1001-3 allow taxpayers to make certain modifications to debt instruments without adverse tax consequences, and such changes may be important in light of the current economic downturn. As discussed, it's also important to document and explain how unforeseen business circumstances caused observed financial results and how those losses were not caused by intercompany prices alone. This brings us to the end of our webinar. We hope you have found this presentation useful. If you have questions related to the material covered in the webinar, please feel free to contact us either by email or by phone. I'd also like to take this opportunity to remind you of 2 additional educational opportunities related to current topics that may be of interest to you. First, please visit our COVID-19 web portal on mayorbrown.com, which is a one-stop resource center that aggregates the latest Mayor Brown legal updates and insights on COVID-19 and includes links to other useful resources. Second, our tax practice will be hosting a 2-part webinar series related to taxation of inbound fund investment exits. On June 9th, we will cover the current tax landscape and what's on the horizon in Asia, the European Union, and Brazil. And during Part 2, on June 30th, we will address initial structuring, exit strategies, and tax controversy considerations in Asia, the European Union, and Brazil related to inbound fund investments. We hope you can join us for these interesting and timely educational opportunities. Thanks, and have a good day.